Thank you for joining us today on Modern Wealth, America's Wealth Management Show. My name is Chris Rett, Certified Financial Planner, joined by Kyle James out of our Indianapolis office. Kyle, thanks for joining us today.
Yeah, thanks for having me. Glad to be here.
Yep, absolutely. So we got an interesting topic today, Kyle, as we enter really the fall, and as we start wrapping up towards the end of the year, we're getting into really end of year planning, and one of those is really centered around charitable giving. So I know this type of year, if we haven't done it already, it's a great time to start thinking about what charities do we want to give, what types of gifts we want to do. And as you know, with your background, there's a lot of tax implications that come around with these sort of topics.
Oh yeah, no, this is a big time. A lot of people do plan around this time of year specifically for charitable giving. So, and yeah, a lot of people don't realize there are several ways to donate and to get the best tax benefit that you can. So why not do a good thing, give your favorite charity, and then also uh, get a tax benefit for it as well.
That's exactly right. That's what, so many times I've had conversations, and I'm sure you have too, where, you're sitting down with a client or a prospect and you're saying, hey, how you're doing it is great. We want to focus on the charity and them receiving the benefit, but there's no reason why it can't be mutual beneficial, and making sure that, the giver is also receiving a tax benefit in that as well. And that's what we want to talk about today, is making sure the listeners and the viewers of this are getting the most tax benefit they can, which might even incentivize to do a little bit more. But ultimately, you're exactly right, is we want to focus on the organization, the nonprofit, the charity getting the benefit. But to your point, is we do want to make it mutual beneficial to the giver as well.
Yep, absolutely. Couldn't agree more.
Well, great. Well, so, and I know with this episode too, we want to talk about some of the differences in the One Big Beautiful Bill Act that got passed here in July. Corey has a funny saying around here. Some thinks it's beautiful, some thinks it's ugly, but I think you would agree, Kyle, there's no distinguishing. It is big, and it did have some changes to it.
Yes, I'm more of a try to go a Star Wars theme. Calling it the OB3 for those who reference the Obi-Wan Star Wars.
Yeah.
So I'm a Star Wars nerd here.
No, that's okay. So. That's okay. So in today's episode, we want to discuss the question: are you still getting the tax deduction for your 2025 charitable gifts? If you're not sure, you might be surprised. And according to an interesting stat from TurboTax, under the current tax laws, nearly 90% of filers now take the standard deduction. That means their charitable donations provide them with no additional tax benefits for this year. Today, we'll discuss the strategies that allow you to do good in your community while still getting a significant tax break in your 2025 return. Later in the episode, we'll walk through a hypothetical scenario of a 76-year-old widow who wants to support her local zoo and show her the most powerful tax efficient way to make that gift. And then later on in our Do Not Do That segment, we'll cover the simple IRS paperwork mistake that can cause your entire charitable deduction to be disallowed, turning your good deed into a tax nightmare. So let's get started with the core problem. Why did charitable giving get so complicated for so many? And what are the main strategies you can use to fight back? Let's start with the strategy of bunching donations. So Kyle, as we get into the standard versus itemized deduction, that study from TurboTax, does that strike you as pretty dead on, or do you think that number is higher or lower than what it was expected? And then we certainly want to get into tax strategies like bunching and donor advised funds as well.
Yeah, no, that sounds pretty realistic to me. I think that 90% is a good number. And it's even something that we see on a daily basis as well. So, yep, that all makes sense to me.
So let's talk about what the OBBA or the OB3, as you call it. I like that. I might have to start borrowing that.
Yeah.
So with that, what are some of the things that you see as it relates to the standard deduction? I know that increased, and does that play a factor in some of these standard deductions versus itemized filing?
Oh yeah, absolutely it does. With the increased standard deduction, now we have to get a little bit more creative on how we give the charity, and especially creative on how we can also get the dual benefit as we talked about earlier. So yes, a lot of tax planning can really help out with that increased additional deductions now.
Yeah, and it wasn't, we're not just talking about small numbers here. So again, in 2024, the single filer, I'm showing that the standard deduction was about 14.6 thousand for the single filer. For the joint as of last year is 29.2. So again, 29.2 thousand, so 29,200. That increase in 2025 to 31,500. So
Hmm.
that takes a lot of donations for you to get into that itemized territory.
Yes, it does. Yeah, 31,000, that 500, that's, I mean, that's a big number for a lot of people. So, yes, we're talking, yeah, substantial charitable giving for sure.
So, Kyle, do you want to talk about the additional standard deduction that our seniors get under the OB3 bill?
Yeah, of course. Yeah, so this is just one of those additional, I guess, tax benefits where if you are 65 years and older, then you get an additional $6,000 per taxpayer. So if you're a joint filer, that's an additional 12,000 if you guys are both over 65. So even further increasing the standard deduction, so making it even more difficult to itemize.
Yeah, yeah. So, do you want to talk about how that might factor into somebody saying, okay, if they're listening to this show or they're watching and they're saying, hey, I'm a giver and I happen to be in that, giving 30 to say 40, 50,000 and upwards, and you're married filing jointly, or maybe you're single filer, and that standard deduction is cut in half. What might that look like from a standard deduction versus an itemized deduction of somebody that is and again, maybe let's say they qualify for that senior deduction, that additional. What types of amounts are we talking that we have to donate in order to really get into that itemized territory?
Sure. Yeah. So from a joint filing perspective, I think the max would be like $46,000, maybe 46,500 or 46,700, I believe. And I mean, let's say you just have your property taxes. Maybe at that age you've got your mortgage paid off, so don't really have any mortgage interest.
Mm-hmm.
Um, let's just say maybe average property tax is 5,000, maybe give or take. But
Sure.
so I mean, you're probably looking at least what a $40,000 minimum, 42, $43,000 minimum charitable donation just to even break that $46,000 cap. So I mean, it's a material number for a lot of people for sure.
That's exactly right. That's exactly right. So what I want to jump into then is to your point, is that one of the strategies that we implement a good deal amount of, and I'm sure you do too, is bunching. So
Hmm.
if you would you walk us through the bunching strategy, what that looks like and how that can change, like you said, categorically moving that standard deduction now and allowing somebody to itemize and maybe take advantage of some of our other tax strategies. But will you start us off talking about what bunching is, and then how is it applicable to somebody that says, hey, I might be donating that much, but now I can utilize the itemized deduction maybe versus a standardized deduction.
Yeah, sure. So bunching strategy is basically when we take 2 to 3 years worth of ordinary contributions and what we bunch them together into one calendar year. So yeah, so if you annually give $20,000 per year, um, we're not getting enough to get over the standard
Mhm.
deduction. So we will bunch those 3 years together. So $60,000 we will contribute in one calendar year to get that deduction. So that way we are well over the standard, and now we get benefit for our deduction.
No, that makes a lot of sense. And so, though, for those listening, if they're not familiar with bunching, Kyle, to be very clear, this is not shortchanging. The charitable they're still going to get. If you're saying, hey, I donate 20,000 a year, they can still maintain that schedule, or they can alter it however they want. But to be clear,
Mhm.
we're not talking about shortchanging the charity at any level. We're just saying, hey, if you bunch it together, you might be able to put you over that hump of that itemized, or excuse me, that standard deduction, and now being able
Yep.
to itemize. Is that your understanding?
Yes, and that's what makes a donor advised fund so powerful is you can put your 60,000 in the donor advised fund, and then you have full control on how you give to the charities you want to give. So you can still maintain your annual giving, say $20,000 per year in this example,
So we're not shortchanging anybody, as you said, but you are still getting the benefit of the tax deduction.
Yeah, so let's walk through logistically on that a little bit. Let's stay with that idea of that bunching strategy. So how does one carry that out? They say, okay, and this goes without saying, Kyle, is that we don't recommend anybody listening to this that if they hear this and this strategy is applicable to them, that they're not doing it on their own. This is something that you would want to get a professional like Kyle James or somebody from Modern Wealth or a professional to help you with this. Is that let's walk through the logistics of this, is saying, okay, I've raised my hand. I think this strategy works for me. I'm looking to itemize this year. I still want the charities to get it systematically. How does one carry this out?
Yeah, so definitely you want to make sure that this fits in your financial plan and your tax plan. The two should be married together, should be talking right hand, left hand. And definitely, so we determine, okay, here's an amount that makes sense for me. And let's say that is that $60,000 number. What I'm going to be doing the next couple of years is not going to be advantageous to me. So let's devise a plan so that we can do it this year, get the benefit. Then we would put the appropriate accounts in place. And then as long as that gets funded by the end of the year, December 31st this year, you are still eligible for your tax deduction. And everybody wins. You win, charity wins. So it's a home run.
Okay. So let's talk about where something like a donor advised fund versus, say, donating an appreciated stock versus a QCD. Where do some of these strategies fall in line with being able to do something like bunching?
Yeah, so really the bunching would be with the contributing to the donor advised fund. You could do appreciated stock as well. Both of those would be appropriate on the bunching strategy. So with the you can contribute both cash or stock to the donor advised fund. Still do the exact same thing. And with the so should I go into the mechanics right now on the capital gains? Yeah. So on the attributing your appreciated stock. So this is a situation to where maybe I don't have a lot of cash on the sidelines, but I have an account that has really low cost base of stock. Let's say maybe a Microsoft I've had forever. Yeah. It's got a huge gain in it now. But I want to give to charity, but yeah, this is my only liquid cash I have. I don't want to recognize a gain when I sell it, right? So with the donor advised fund, you have the ability to put that highly appreciated stock, whatever it is, into the donor advised fund. You get a deduction for what that stock is valued today. And then when we sell in the donor advised fund to actually give it away, there's no tax cost for that. There's no capital gains tax on that sale. So it's maybe a triple benefit, if you will. So you're still giving to charity, you get a deduction, and we're avoiding the capital gains tax that way. So that's another situation where people kind of overlook as far as getting a little creative on our giving strategy.
No, that's a great point, Kyle. Is that say you hit we have some people come to us and hey, I invested in this company, a small company called NVIDIA, a couple years ago. Seen a lot of appreciation there, and so what you're saying is that they can take that. They don't have to realize the gains on that. By selling it, they can actually just donate the appreciated stock. And that way they're not paying the capital gains. They're getting the full write-off of what the value of it is, and the charity gets it.
Mm-hmm. Yeah, you're exactly right. So it's a win-win-win for sure.
This show is made possible by Modern Wealth Management. Whether you're seeking guidance on preparing for retirement, navigating taxes, or planning your estate, Modern Wealth Management team of financial professionals are here to help. Contact the team today at modwm.com. That's modwm.com to learn how we can help guide you to and through retirement. Thanks for tuning in. Now let's get back to the show.
And just to circle out the bunching, is that on a highlight, just talk about how donor advised funds then work in tandem with that bunching strategy, and why somebody might want to use a donor advised fund.
Yeah, so the donor advised fund is it's a tool to be able to be able to take advantage of a current year donation when I otherwise would not, when I would have lost that due to the increased standard deduction. Not only just from a giving strategy on a deduction strategy, but also if I have a higher income year this year for whatever, maybe I'm getting a large Christmas bonus or whatever the case may be. And it's not likely to have that same bonus next year. Same thing applies. This be a good year to bunch my donations together so I can not only have maybe a fourth benefit here as I can reduce a high income, but I can also now get a charitable deduction for it. And then I'm also still meeting my charitable obligations that I want to do.
Nope. That makes a ton of sense. Kyle. So we've talked, Kyle, now high level about, different tax strategies. We talked about bunching. We talked donor advised funds, hit on QCDs a little bit, and we talked about donating appreciated stock. So what I want to do now is that let's apply this to the real world. So let's do a case study, if you will. So we've got an idea, and then we can apply some of these strategies. So let's meet a hypothetical woman named Jane. So Jane is 76. Her husband passed away about 2 years ago. She's in good financial position. She's living on Social Security, her husband's pension. She also inherited a large traditional IRA. And now this is combined with her IRA. So again, the goal, Jane is retired and financially comfortable. Her required minimum distributions now are quite large, which adds a significant amount to her taxable income, something that we see quite often, Kyle. And so she also happens to be very charitably inclined and wants a meaningful gift of $25,000 this year to her local zoo and help them build a new exhibit. So here's the default, right? So we're going to do a little bit of a case study. Here's the default. So Jane's first instinct is to pull $25,000 from her IRA, have the taxes withheld, put the rest in her checking account, and write a check to the zoo. Kyle, what's wrong with this?
Yeah, so the taking that out of her IRA directly to herself, that does we created a taxable event there. So because it came directly to her, yes, so we are paying tax on that. That is included in her adjusted gross income, which depending on what her Social Security, maybe your pension, plus the RMD. I mean, then we have a possible IRMA situation, which is an additional Medicare surcharge. So strike one there. And then on the deduction there, she's given $25,000. Yeah, it's enough for the standard deduction or the itemized deduction as a single taxpayer. But at the same time, we have income on page 1 of your tax return, your income. Then we have the deduction on this side. So it's like a tax wash, right? We're not saving it. There's no benefit to Jane for doing that.
Yeah, so let's revisit that. So to your point, so she's already receiving pension, she's already receiving Social Security. So by taking this, and then mind you too, one thing we probably didn't talk about a whole lot is, and that happens quite often, Kyle, which is why tax planning is so important, is she's going from a joint filer to a single filer. Mm-hmm. So she's going to accelerate through the tax brackets quite rapidly. She's going to get half the standard deduction. And so this could have monumental effects on her. So to your point earlier, so she's going to increase her AGI, right? Mm-hmm. She's going to withhold taxes on the distribution, meaning that $25,000 gift is now going to be less than that. And to your point, she might have to pay extra Medicare premiums next year as a result of this. Yeah, this is not a wise strategy, but Kyle, this is not something out of the ordinary, right? We do see this of people coming to us, and this does happen, right?
Oh, yeah. Yep. All too often.
Yeah. So what we want to talk about is one of the ways that we just talked about is perhaps an alternative route to that might be a lot easier is donating appreciated stock. So the alternative, the first alternative, Kyle, that I want you to consider is what if so let's say hypothetically she has a taxable account. Maybe it's a brokerage account that she had with her husband. And let's say she's got $25,000 worth of stock that she bought 20 years ago for $5,000. Yep. So great appreciation there. Great investor by the way. And then she could donate the stock directly. How would that monumentally change, from the first scenario?
Oh, sure. Yeah. We're just donating the stock. We're not recognizing any income to her. We're not taking a an asset that has ordinary income impacts to it, attributes to it. And so that's not even I guess it's a moot point there, I guess. So we're not cashing out the IRA to do that. The donating the stock is now more tax efficient, just because now we can give away an asset that has the capital gain. I don't have to sell that and recognize the capital gain, and I'm still getting a deduction for it at my fair value, not the cost basis. So it's like that gain doesn't even exist when it comes to donating that piece of stock to the charity.
Nope. So great point all the way around. So let's compare that to how it happened the first time. So by donating appreciated stock, she's not increasing her AGI by increasing taxable income. She's not increasing her IRMA premiums potentially, and the charity is getting all 25,000 of the donation. And on top of that, she's not having to realize capital gains when she sells that stock and donates it.
Correct. Absolutely.
Okay. So not a bad strategy to consider if that somebody is they have appreciated stock, maybe they have RMDs and they're using their RMDs for their lifestyle and they want to donate to charity. This would not be a bad option.
No. Nope.
What I want to consider now, Kyle, is perhaps my favorite option. I don't know about you, but now it's the QCD, the qualified charitable distribution. So walk us through. I know we've talked extensively, here on the show about what a QCD is, but Kyle, let's talk about first about what a QCD is, and then let's see how it relates to Jane and her scenario.
Yeah, so QCD is short for a qualified charitable distribution, and that allows a person who has an IRA, if they're over 70 and a half, they're allowed to take a withdrawal from that IRA directly to the charitable organization, and it is a non-taxable event. So what I mean by that is when it goes directly to the charity, you don't it's not included in AGI, it's not included in income, but on the flip side, there's no tax deduction. It's as if in the IRS's eyes, like it didn't exist. It's like a transaction that is not reportable. It's reportable, but it doesn't affect income in any way, shape, or form to you. Versus taking it directly to you, putting it in your bank account, and then writing a check to the charity or the zoo in this case. Then we have a taxable event along with a deduction. So not as efficient by doing it that way, but the QCD, qualified charitable distribution, would be the most efficient way here.
No, I completely agree. And my favorite part is that it satisfies the RMD. So let's say, she's at a lifestyle now where Social Security and pension are covering most, if not all, of her lifestyle. And not to mention, it sounds like she had a brokerage account she could dip into if she needed to. But, what the RMD forces a lot of people sometimes into those higher tax brackets, those Medicare surcharges. And so something like a qualified charitable distribution or a QCD is my favorite because it goes towards that RMD. To your point, it's not taxable. And really checks a lot of those boxes. And Kyle, it surprises me how much we talk about this and how much people you would think are familiar, but we still see it time to time. I actually had a client of mine, I had to re-talk her into it. She was donating unbeknownst to me, and we looked at her tax return and I had a conversation. I was like, why don't we use QCDs? And it sounded like something we were pulling, the eyelids over her eyes to say, hey, here's a dirty trick. And it felt wrong to her, but we showed her all the benefits. And she goes, she walked away very impressed. And this has been a client that's been there for 10 years, but she wanted to do it. It was an old habitual thing. And we had to talk her out of it. And this is somebody that we had an incredible amount of trust with. Again, it was something that our CPA sat in on it, but it feels wrong in a way, Kyle, but yet it is one of those that is the most powerful strategy for a lot of reasons. And again, when it makes sense, but I would completely agree with you here on the QCD. Anything we want to wrap up on the QCD before we switch topics here?
Yeah. And then just to reiterate, I know a lot of times people will say, oh, I'm not RMD age yet, I can't do a QCD. So no, that is not the case. You only have to be 70 and a half, not the new 73. So that's very, very important to understand. So You do not have to be RMD age to be able to take advantage of the QCD.
Yeah, that's a great point, Kyle. We have to go back in the day when RMDs used to start at 70.5, and then once the Secure Act passed, charities kind of raised their head and said, wait a minute, if we start, what was back then the RMD age is 72, now 73. Charities are saying, wait a minute, a lot of these people like to use QCDs, and the IRS, your point exactly, said, hey, we can maintain the 70.5 for the QCD. So great point. If you are 70.5 and you're charitably inclined and you're not needing your IRA, again, a QCD can be a very, very powerful tool. The only other thing I would like to add to that, Kyle, too, is to keep in mind that QCDs can go up to $100,000.
Yes.
So, or actually, I should say that
108,000.
OB3, excuse me, is that I stand corrected. Is you want to talk about OB3 and its effects on QCDs? Thank you.
Yeah. No, they're indexed for inflation now, which is good. And now for this year, it's $108,000. So, and then once again, that's per taxpayer. So a married couple, if they are very charitably inclined, have large IRA balances, it could possibly defer up to $216,000 out of their IRA into a charitable organization. And with the new cost of living and adjustments now going forward, so that could be some material givings going on to be able to take advantage of some major tax benefits there.
No, that's great stuff, Kyle. That's great stuff. So now we've talked about, our charitable strategies, and we've talked about how this relates to perhaps a real world scenario. I want to shift gears here a little bit now, Kyle, and we want to go into the newer segment called the Don't Do That segment. So the idea is this meant to be somewhat comically, but also very serious in nature, is that, a series of people out there that are perhaps doing the wrong thing, and it's going to be our job to dissect that. So for the first Don't Do That, we want to look at some of these topics. And so let's start with a scenario. Bob, let's call him Bob. He's very generous, and at the end of the year, he writes a check for $5,000 to his church, and then donates $10,000 worth of appreciated stock to his alma mater. He files his taxes, claims this $15,750 deduction, and a year later gets a letter from the IRS. Kyle, from the very brief description we have here, what's the mistake Bob made?
Yeah, so a couple things. One, you need to have a receipt for the charitable organization. That is absolutely crucial. You have to have some kind of documentation or proof that says, hey, I in fact did this. A canceled check or a bank statement is not proof. That will not count. And then in addition, on the stock contribution, there are, in true IRS fashion, another form that you have to fill out when you are donating other investments or other assets other than just cash. Stock is especially, there's another form that you have to fill out that says, let the IRS know this is not a cash contribution, this is just stock. So yes, those two things are crucial to make sure you have all your ducks in a row when you are doing your charitable giving.
Nope, that makes sense. So to your point, Kyle, Bob, don't do that. Don't do that. Make sure you get a professional like Kyle to help you with that.
Yeah. So just one more point I want to make on the receipt that you need from the charitable organization. The language on the receipt also matters. It must say you receive no goods or services for this donation. Here at Modern, if we see a receipt that does not have that language on it, we will make you go back to the organization to get that language on it. That is of utmost importance. The IRS will deny that contribution if that language is not on there. I know it's a small item and is often overlooked, but you should be double checking your receipts to make sure that language is on there. That is very, very crucial as well.
No, that's a great point, Kyle. Because it sounds like Bob did his homework here, but the IRS doesn't play games when it comes to these sort of things. And so the first thing anybody always wants to make sure is that, and I would say too, is you want to make sure that the organization is in fact a nonprofit or a charitable organization too.
Yes.
I think that goes without saying, but you would be, I'm sure you've seen it before. You would be surprised with some of the things that comes across our desks.
Oh yeah, the IRS does have a actually a pretty good search tool on their website where it makes it easy to type in the name of the organization, and it should pop up on the IRS tax exempt list. So if it doesn't, then I would go back to the organization and maybe confirm, hey, I just want to make sure that we're good here.
Yeah, no, that's a great point. And so you never want to have people make tax related mistakes, but if they are, make sure everybody else learns from them. So Kyle, thank you so much for joining us today. So as we wrap up, we talked about different tax strategies. We talked about how the OB3, again, I appreciate you mentioning that to me. I'm going to have to steal that. But, we talked about the effects that had on charitable donations, itemized deductions. We talked about some strategies here. We talked about a real life case. And we talked about, our poor friend Bob here and what he shouldn't do. What else, should listeners that are listening to this or viewers consider as they wrap up the end of the year and they want to perhaps be charitable? Maybe they're called to charities, or maybe it's something they've always wanted to do. What's something that, we covered today, or maybe we didn't cover today, that we want to reiterate?
Well, yeah, I just want to, contrary to what most people think, the tax code is actually here to help you. Especially in the charitable giving arena. There are a lot of strategies that we can implement that can benefit you and the charity. So it's just kind of based on everybody's individual situation. But if you are charitably inclined, we here at Modern are well versed in all the strategies available to you. We'll go through your tax plan, your goals, what you're trying to accomplish, and we'll kind of devise a strategy that fits best for you.
Nope, that's exactly right. And so that would be my takeaway: is you want to have a team approach. You want to have, to your point earlier, you said it best, left hand needs to know what the right hand is doing. And so I go back to my client that we spoke about earlier. And if you're listening to this and you're making donations or you're making contributions, even if it's just the weekly amount to your church or an organization that's special to your heart, is if you're having somebody assist you on either the tax side or your financial planning, make them aware of it so that way they can help you help the charities. Because again, to your point, which is the whole premise from the episode, is that we want to encourage people that want to be generous with the resources to be generous, but we also want to do it in a way too that can be tax beneficial to them. So again, Kyle, thank you so much for joining us today on America's Wealth Management Show.
All right, thanks for having me.
The views expressed represent the opinion of Modern Wealth Management, LLC, an SEC-registered investment advisor. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Modern Wealth Management does not accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action.